What if this current administration thinks that we have to reset the system and it's better to do it by other countries dumping the dollar? We warned them, how can they do it to us? And well, here's what we're going to do to retaliate, blah, blah, blah. Rather than just the flat out reality of the fact that how the hell do we pay $28 trillion in treasuries that come due in 3 years with only $15 trillion in tax revenue?
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for April 14th through April 21st, 2025, while supplies last. First this week, we feature 1-ounce silver Canadian maples at their lowest premium in years at just $3.49 over spot. Next, 1-ounce Gold Philharmonics are only $65 over spot. 1 10th-ounce Platinum Britannia are just $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us for this weekly market update. Today is Wednesday, April 16, 2025. Andy, thanks for coming back on Liberty and Finance.
It's good to be back then again. Thank you. Appreciate it. Nice to see you.
Welcome back home to the US of A. Hope you're not going to be badly jet lagged.
No, not so bad at all, actually. It was a nice time. It was nice to be there, but it's good to be back. You realize how much you appreciate the United States, even in going to places that are as friendly and first world as Rome and Prague and Barcelona. But certainly I love my routine here back in Florida.
Wanted to talk with you about today seeing gold over 3,300 for the first time in history. The resilience and the strength of gold in face of everything that's gone on is remarkable. There were some temporary smackdowns right after the election, or a few other things, and tariffs were installed. But what are you seeing in the gold and silver markets for starters? And then we're going to talk about a number of other things that were suggested ahead of your arrival here.
I mean, let's just put it in perspective. And again, really all of this stuff started changing when I started coming on your show. We started by talking about gold's reclassification as a tier 1. We talked about the central banks going on a buying spree. We talked about the central banks going on a repatriation spree. We've seen the rise of the classification called the others on the COMEX that had started draining the COMEX in 2020. I started saying to you on your show, this has never happened before. What the heck's going on? We've seen this trend continue. We see the central banks continuing to buy gold and silver. We see, and those numbers increasing. We see the repatriation by central banks continuing. We see the United States become a net importer of gold and silver, in particular gold, since November. We see massive deliveries into the COMEX since November. We see a LBMA breaking down. We see an LBMA that was T+1, now T+8 weeks. So from 1 day plus the trade day, 3-day settlement, you're now at 8 weeks. That seems like a default. We see JP Morgan, who always I lamented, how could they be allowed to be the custodian of the world's largest silver trust after paying the largest fine the Justice Department ever handed out for manipulating the market? Well, they've now become primary custodian along with BlackRock, not only of SLD, but also GLD. In 2 vaults, they hold more gold than 80% of the G20 countries. All of these things together are substantial. You put them together, something much bigger is happening. You look at Judy Shelton talk about 50-year treasuries that she is convinced will be announced on July 4th, 2026, the 250th year anniversary of this country. She says Trump has told her that. They've had discussions on it. You see talks from the head of the Dutch National Bank and the Bundesbank and Senator Loomis from Wyoming talking about revaluing gold. All of these things continue to come together. And maybe what's even the most interesting about all of it is that gold's at all-time highs, but how many people even know it? Yeah, the people watching this show know it, but no one knows it. I mean, it's so underplayed by the media. It's absolutely crazy. And if you would have told me we'd be at 3,300 gold and no one would notice it, I would be completely dumbfounded. And that's where we are. The retail hasn't taken part in this at all. So as we've talked about on your show a million times, the little man rule, or just the very fact that the big money always positions in front of the herd, well, you could argue that's what we see right now. And everyone's been waiting for the other shoe to drop in gold. You know, it did drop while I was in Europe, of course, and fell by $200. But when it fell by $200, the amount of closing out of open interest was in the billions of dollars. In other words, the managed money who had gotten really long against large short positions by the commercial banks, you know, how many more times can they do this? Can they drop the price down to bail them out? Well, that's what they did. They smashed the price and they closed like $4-5 billion, maybe even more $1 billion worth of contracts that were open, that could have stood for delivery. And then the price goes up $300. And the same thing is true with silver. So there are desperate attempts to keep the price from rising too fast and being on the wrong side of it. And yet, even after they smash it, where in years past it never would have come back, here we are way past where it started when they knocked it down to almost 3,000, just under 3,000, I think, from around 32 and change to now over 3,300. And it's come back in a matter of 2 weeks. And so there's strength and something going on in the gold market. And you put all of these things together, you have the biggest money in the world accumulating and onshoring and repatriating gold, getting out of the system. You have talk of gold being integrated into a new system. Even the BRICS has said, Dilma Rousseff, we've agreed to a new settlement token, the unit, backed by and redeemable in gold. All of these things, how many clues do we all need to understand that gold is going to be somehow, some way, whether it be through the unit, whether it be through gold-backed treasuries or something that we don't see. Gold is reintegrating into the monetary system. And the biggest players in the world, I don't care what they say, their actions are telling you that is indeed the truth.
We've also had several viewers and clients emailing and texting, asking if we could please talk to you about the gold-silver ratio. When it hit an extreme several years ago at like 120 to 125 to 1, gold to silver, you made an analogy. It's like a snowstorm in the 4th of July in Key West, Florida. It says you just don't see things like this happening. Always take advantage of extreme upsets in ratios that are completely out of whack with the average. Right now, we're about 100 to 1 or more a gold to silver ratio, which is still an extreme historically. Can you talk to us about what you're seeing in that regards and what it's telling us about the relative strength of gold to silver at this particular stage of the bull market and what you see ahead for that?
Well, you know, typically gold goes first, silver goes further. I mean, that's a truism that there are many examples where you can show that, but gold has gone first for sure. The setup for silver is even stronger and more compressed, like a coiled spring, than with gold. And it's the reality that people don't want to deal with, that silver is more important than gold to some of the very big players like the military industrial complex, as we've talked about, who needs copious amounts to make their high-tech weaponry. And that works real well in an environment where no one's buying silver. But the amount we saw 50 million ounces delivered into the first day of the March contract, 50 million ounces on day one. And so the demand for silver is off the charts. You're seeing India buy 900 million ounces of it in the last 4 years or thereabouts. That's more than the COMEX and the LBMA combined. And you see China, the second largest producer in the world, flying all around Latin America, buying doré and concentrate. What do they need to do that for? And then sending it back to be refined. It's being accumulated by the state in Russia, the first government that I know of that's made a public admission of this. And so, you know, the amount of silver drained from the LBMA, 70 million ounces, all-time monthly record in January, huge deliveries in February, and very large deliveries in March, although the LBMA is kind of putting the brakes on it because they're getting bled dry. Evidently, it's a shortage of trucks in the UK that is not enabling them to continue to deliver at the same fashion. But any way you look at it, this is an opportunity that you don't see very often in investing ever, where if you traded your gold to silver, a double plus would be just reaching the 200-year average, price average of the two, which would still be over 6 to 7 times higher than it's coming out of the ground at. It's one of these deals where, I think the asymmetrical risk reward in trading gold to silver is probably the lowest I've ever seen, where you trade an ounce of gold, which in fact I did it gold eagles to silver eagles today. And it amounted to 85, 86 ounces in eagles. If you were to do it in something else, it would be even more. But even 86 to 1 in real terms is off the charts. So, you get 86 ounces of eagles for every gold eagle or thereabouts. And if all that we saw was that it went back to its 200-year price average of the mid 40s, you double what you started with by trading back into gold. And I think it's a no-brainer. So yeah, these are trades you don't see but maybe once or twice a lifetime or a career. It is a no-brainer from a standpoint of historical context in both gold and silver pricing and in their relationship.
You've also talked to me about the basis trade opportunity. Is this what you're describing, or is there something else that we need to let everybody know about?
No, the basis trade is what we've seen happen just last week with the stock market and the bond market moving in opposite directions. And it was, in essence, the bond market coming this close to breaking. It's the exact same thing that happened with long-term capital management, the hedge fund, I think in the late 90s, that the Fed had to bail out because it was this close to breaking the entire system. And in essence, what it is that, and especially, and by the way, long-term capital management was a grouping of Nobel and like prize-winning economists. And I think a couple of them, or one of them, had won the Nobel Prize in economics. These were the smartest of the smart. They figured it was a risk-free trade. In essence, what they do is they buy as many 10-year treasuries as they can, and they lever up on it by going massively levered with using derivatives to buy as many 10-year treasuries as they can, and then simultaneously they short the 10-year treasury future, which has a little bit of a premium to it, and they just capture the spread because when it expires, they net each other out, and you just keep the premium. And that's supposedly a risk-free trade, and because of the Dodd-Frank Act and these banks can't do speculative things anymore. Well, so that's what they do. They buy all of these treasuries, and the Fed likes that because we've seen central banks selling. So get the hedge funds to load up on treasuries to massively use the collateral, if you will, to use the fractional reserve system type of environment of levering up those treasuries as much as 100-fold. Even at 20-fold, a 5% drop wipes out the whole thing. But at 100-fold, a 1% drop wipes out the whole thing. So you have these banks who think it's risk-free. They buy treasuries and sell treasury futures to simultaneously capture the spread. Well, what happened was last week when the 10-year treasury went up by 60 basis points at the same time the S&P dropped by 8%. They're supposed to move inverse of each other. If the S&P is throwing up, the money should be running into treasuries, into the safety of treasuries, which would lower rates. But in essence, what happened is the rates started to spike for whatever reason, which it blew out the short-term lending rate. So those short futures got margin called. And because it went up so fast, it went up 60 basis points in 3 days. It's the biggest jump in bond yields in 3 days since 1982. And it's probably the sharpest split between bond yields and stock prices ever. And so what happened was all of this selling, these hedge funds got margin calls and had to sell their treasuries, which pushed rates up even higher. And this is exactly what happened to long-term capital management. And so you're talking something that was hopefully contained, but it goes to show the amount of leverage that's in the system. And very easily, at the exact same time, we have $6 trillion in treasuries coming due next month. $6 trillion. We have 28 trillion due by 2028 with only roughly 15 trillion in tax revenue. That's a problem. How do you come up? You're 50% there and doesn't even take into account the spending we're doing between now and then. So a lot of people talk about, Trump was trying to push the stock market down, talk it down so that rates would go down. People would jump into get out of the risk on trade and move into the safety of rate treasuries, which would push yields down to refinance this $6 trillion in debt that comes due next month. It went the other way. At the same time, this is when we need it most because our foreign investors are losing confidence in this, especially as the trade unwinds and these funds are forced to sell. It causes sudden and violent moves in the bond market, in the debt market. And how much longer are these creditors of ours going to keep lending us money for 10 years at 4%? With this kind of volatility, when our deficits are running closer to 7% of GDP, when inflation's running higher than 4%, and we have this kind of volatility, this leverage created by the hedge funds that very quickly can blow things up by almost 1% in 3 days. That doesn't move that way. So anyways, crazy times and scary volatility in the bond market and the stock market goes to show how fast things can get out of control.
Yeah, a couple of the analysts that we've interviewed late last week and over the weekend were talking about this rising bond yields in the face of falling dollar, and that this is not natural behavior. It's not healthy behavior on the part of the debt market. Any further comments from you on the fragility of the debt market? Because our mutual friend Gregor Manarino talks about that as the much larger market than the stock market or any other market is the U.S. debt market, and that's where, and that's not even counting the derivative complex on top of that, but just the size of the basic market, and that's where he expects to see the signs of vulnerability in the overall financial system. Any further comments from you on that before we move on?
Yeah, I mean, I guess the comment would be what we see happening right now with China. And, so we give a 90-day hold or a 90-day reprieve on these tariffs. They're not tariffs. And I want to just comment on the tariffs for a minute. At first blush, you think, yeah, it is unfair. We pay tariffs and they don't. But is it really unfair? Because all of these countries that are, selling us their goods because we're a more wealthy, industrious nation. Of course, you're going to have a trade imbalance here. The trade gap will look ugly on paper, but and sure, he wants better terms. Trump does. But the idea here is that these countries who we're buying their goods, or they are selling us our goods, our creditor, if you will. They're our creditor in the respect that they're keeping us afloat by buying our treasuries, and they're keeping us afloat by using our dollar as the global reserve, which keeps our interest rates low, which keeps our asset prices high, which keeps the goods that the consumers buy cheap. So sure, the trade gap doesn't look good, but is it fair that we impose these sanctions and we expect these countries to put proceeds into treasuries to support this lifestyle of ours and keep rates low and to use the dollar? And to that point, we are rattling perhaps the wrong saber or barking up the wrong tree. We talk a lot about Project Enbridge and how that got pulled away. Well, here it is again, rearing its head in a different manner. And they're not calling it Enbridge. Let me read something to you. The People's Bank of China, I read yesterday, has announced that its digital renminbi cross-border settlement system is now fully connected to 10 ASEAN countries. These are the countries in Southeast Asia and 6 Middle Eastern nations. This development enables approximately 38% of global trade to bypass the traditional SWIFT system, which is predominantly used for transactions in the U.S., allowing these trades to be settled directly in digital RMB. And here's the thing. It highlights in practical terms China's digital currency bridge. This is the M-Bridge, has significantly reduced cross-border payment processing times from a typical 3 to 5 days associated with SWIFT to approximately 7 seconds. For instance, a pilot transaction between Hong Kong and Abu Dhabi demonstrated that a company could pay a Middle Eastern supplier using digital RMB, eliminating the need for multiple intermediary banks and achieving a real-time settlement with a 98% reduction in handling fees. This advancement is part of China's broader strategy to internationalize the renminbi with initiatives like the Belt and Road, which we've talked about, and the challenge the dollar's dominance and U.S. dollar and global trade. So here you have it. You're pushing these countries into not only joining BRICS like Indonesia did, but to taking this technology and integrating it in with all of the countries that aren't even in BRICS yet. They're all coming together, including the Belt Road, which is 75% of human population and 50% of plus of global GDP. You have to wonder again, could this be intended? Is this what they're trying to do? Under the Biden administration, it was so stupid. It was too stupid to be stupid. That's why I thought it. But here, again, this is why, this is where conspiracy theories are born. Is he the Trojan horse or is he riding on it? I would vote for him again. I'm glad he's here. But I'm simply saying some of these moves, as provocative as they are, creating these consequences. Does he not know that this will happen? And you're doing this now where you see China and South Korea and Japan get together to talk strategy because of the sanctions, because of the tariffs. These are countries that aren't really allies. And at the same time, 2 of 3 of them are the biggest creditors to us in our treasury market. We're pushing all of these countries into alternatives, and it's happening in real time. I think it's a big deal. It's a huge deal. And all of this will be reflecting of higher rates as these countries dump treasuries and go a different direction. Instead of putting the excess reserves, as they always have, into treasuries to keep our rates low and support our debt binge, well, now they're putting it into gold, into other things. What is gold? But the only other tier 1 reserve asset next to treasuries. And it's doubled the performance over the last 25 years. And look at last year, it was up 40%. The treasury was up 4%. Easy decision, no counterparty risk. Same trend we're seeing happen right now. So anyways, these are times where there's so many balls and angles. It's like watching a pinball bounce around. It's hard to follow it and know where it's going next. But I think what's happening with the bond market is symptomatic and emblematic of bigger problems ahead.
You embellished that answer by giving the global perspective of what the BRICS Plus nations are doing. You do a lot of research into the BRICS Plus. You brought that topic to the table and brought focus to it, brought the spotlight to it over the past several years. Any new developments other than the ones you've already highlighted in the...
No, I mean, that is it. I mean, I know that I had mentioned to you that there were some BRICS, but to me, this is the same thing. This is the BRICS. This is, again, thinking big picture. You unite and build the infrastructure between the Belt Road and all of these other nations that are aligned, geographically with the BRICS and with Asia. It's a natural that you would see integration or trading permits, or it's just geographically. If these countries, like all the Southeast Asian countries, had to choose sides between the United States or their neighbors, I have a hard time believing they'll choose the United States. And this is exactly what this is saying. So to me, this is the BRICS. It's an expansion of the BRICS. Even if we don't call it the BRICS, a lot of these countries are the ones who informally express interest in joining the BRICS. Some have formally. Look at Indonesia, is now a full member. There are a lot of these countries that I'm sure are saying, yeah, let's get the infrastructure set up and then we will join, so that it's a seamless transaction, so we don't get hurt by the tariffs or by the sanctions or by a vindictive White House. So to me, it's kind of increasing the BRICS influence through the back door.
Speaking of not getting hurt, it reminds me of when I was a kid in a junior high learning to play checkers, and always thought I was setting up a beautiful double jump, and I ended up getting double jumped almost every time when I did that. Trump seems to be acting that way in presenting that this is going to be so smart business, tough-headed to go against setting up all these tariffs, and he calls them tariffs, etc. But what about, as you mentioned, if the foreign holders of the U.S. bonds and dollars are having enough of that, losing faith and confidence, seeing that they're getting punished, they've been talking about it for a couple of years now, and taking action, how does that likely hurt domestically ordinary moms and pops who are depending on their insurance company, their pension manager, their retirement funds, and all this that are heavily invested in U.S. treasuries, et cetera, to secure their financial futures?
Well, when people hear that the hedge funds are the ones doing this, and the Fed has even floated there's been talk of them bailing out the hedge funds, the positions are that big. Some people would say, well, let them go down, let them suffer. But who's borrowing them the money to make these levered trades? That's right. That's the banks. And so when you talk about rates that are spiking, it could, in theory, blow up some of the biggest banks on the planet, let alone the brokerages. The great taking comes into play. This could have rippling effects through the insurance companies. Of course, rising yields are not healthy for the real estate market, for the stock market, for the bond market, for the banks, for the insurance companies. It's a very big deal. This is what happens when you create a reality for 3+ decades of suppressed interest rates and easy money, which creates distortions and misallocations of resource and capital. And the distortions in the asset prices are greatly distorted when the thought of yields rising above 5% sends massive shockwaves through the entire system. Well, what if they blew through that because everyone dumps simultaneously? This is the same thing that I talked about for years under the Biden administration. It was too stupid to be stupid. Well, what if this current administration actually agrees with that, thinks that we have to reset the system and it's better to do it by other countries dumping the dollar? We warned them, how can they do it to us? And well, here's what we're going to do to retaliate, blah, 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 rather than just the flat out reality of the fact that how the hell do we pay $28 trillion in treasuries that come due in 3 years with only $15 trillion in tax revenue? I mean, how do we continue to fund our military, a $1 trillion military budget this year that's all discretionary, in meaning we need to borrow money by selling bonds? Well, what if no one wants to buy our bonds? Well, that means that you have to see the Fed come in and buy them by printing money, which creates inflation, which, I mean, all roads lead to the same place. We're trapped. The Fed is trapped. And so I think that's, to average mom and pa, yeah, they're a long ways away from the hedge fund world, but the ramifications, the systemic nature of a system that actually contemplates bailing out these companies, because what it would do to the whole system is real. And a system that is as over leveraged and indebted as ours is very dangerous. You bring down one very large bank because of these decisions, the ramifications goes all the way out to middle America and mom and pa, and not just the big hedge funds and the banks on Wall Street.
Yeah, so I want to bring you next, if you would tell us about what you're seeing. And you mentioned there's no mention of this phenomenon of gold telling the truth about what's going on with the dollar, et cetera, on the mainstream financial press in the U.S. What else are we not being told that's going to be affecting, I mean, this being a weekly market update, the retail investing into precious metals by retail investors in the U.S.? What are you seeing right now, and what kind of opportunity, obfuscation is going on right now?
I mean, but it's crazy. You got Goldman Sachs, of course, in their private letters, not the ones sent out to the public, and no mention by the mainstream, saying that their low end prediction for gold at the end of the year is 35.50. That if they see more ETF inflows to the pandemic levels, 38.80 by year end, and it could get possibly near 4,500 an ounce by the end of 2025. That's coming from Goldman Sachs, and we don't hear any talk of this. We have gold at 3,300, and no one is talking about it. Again, it's invisible to the public, and so I don't know how it all plays out, but I'll tell you, I would say that we are far, far, far from the end of this game, because, as you know, I mean, the fact that gold is at these levels and the mainstream public is asleep, there's very little, if any, retail demand pushing the price higher. Yeah, there is our retail demand, but the mainstream has no idea. And so when you realize that this has been driven again by the big money, as we've often talked about, the hedge funds, the family offices, the sovereign wealth funds, and the central banks, and the average person is, again, missing this altogether. That's what's so special about silver. Look, silver's been held down, and I will, to the day I die, believe it's the military-industrial complex and their desire not only to make weapons. I mean, BlackRock owns all the weapon-making companies just about, and they're the custodian of GLD and SLV, and Well, they pay for and make the bombs to blow up the countries and then win the contracts to rebuild the countries. It seems like a pretty sweet deal for them in terms of money. They needed to keep silver cheap in order to do it, but things around the world are breaking, whether it be deliveries into the COMEX, the deliveries out of the LBMA, which are breaking the system. China flying around the world and buying doré and concentrate as the second largest producer in the world. All of these things are saying that there's, silver is, in my opinion, the asymmetrical champion, risk reward, low downside, high upside. It is maybe the most undervalued, best bet of an asset class on the planet. And yeah, it's easy for me to say it as a guy that owns a gold company. I'm tired of even defending that. If you don't see that for what it is, you're not paying close attention. And yes, it's enough to make you pull your hair out of your head, but it will catch up and perform similar to gold, only I believe at a much higher clip in terms of percentage gain. So for me, silver is still the preeminent value. And even if you buy silver with the intention of someday converting it to gold, all it does is fall back to its 150, 200-year average of mid-40s to 1. It's a double. So, if you could buy 10 ounces of gold today, you put the equivalent into silver. And when the ratio corrects just to its average price of nearly 2 centuries, you're still 6 to 7 times off of what it's coming out of the ground at that price. I mean, that's a long way from where it should be. It's a double plus. So yeah, I think it's an opportunity we don't see very often.
Before we let you go, if you could hit quickly the weekly specials. I noticed we do have North American Canadian silver maple leafs, which are not dealer reportable in any quantity when we buy them back, on special that would allow people to get into silver at an affordable premium.
So yeah, for the 2025s, it's very cheap. You're probably $1.50 more on American Eagles. They're the purest silver coins in the world. You could argue from a standpoint, they're a better value than the Eagles. I like the Eagles better just because, no real reason, but you're talking the purest silver coin in the world from a North American mint at $3.49 over. It really is a good price for the maple leaf and an amazing coin.
And maybe a good target for that gold to silver swap opportunity that you were describing, that people may have been waiting for an extreme gold silver ratio like we have now to pull the trigger on that one. And
right.
Maybe able to achieve that.
That's right. You want to get more ounces in doing the swap. I agree. Backdate Gold Philharmonics. The Philharmonics are a cool coin. One of the only coins that don't have some form of a president or a king or a queen on the back. It's got the big orchestra, organ on one side, Philharmonic Orchestra, and then some stringed instruments, I believe, on the other side. Cool coin. One of the most widely traded coins throughout all of Europe. One of the 6 major mints. Good value if you're looking for gold. We have the Platinum Britannia 1/10 ounce at $29 over melt. I'll tell you, platinum on many levels seems to be such a hell of a bargain. The U.S. Mint, to my knowledge, has not made any Platinum Eagles this year. They only made about 30,000 last year. Platinum is very hard to get, and the relationship between it and gold is as disjointed and in many respects as is silver to gold. Everyone should have a little bit in their portfolio, and this is a nice way to have some small tradable pieces as well. And then to the constitutional pre-65 dimes and quarters at $1.99 over spot, my favorite choice. Again, premiums are climbing. As you can see, we were offering this not too long ago to $1.49, but it is my favorite choice, utility-wise, and really potential-wise. As we've mentioned last few times, we talked about it here. During the pandemic, premiums were north of $10 to sell it back to us and $11 and $12 over or higher to buy it. So, I think it represents probably the very best value in silver with the greatest utility. It would be my number one choice, believe it or not. It just doesn't have the wow factor like the Maple Leafs do. They're old dimes and quarters. So, if you want the beauty and the wow factor, it's in the 1 ounce coins. That's important to some people, and I understand that. But if you're looking for the greatest value with utility, it's the constitutional silver.
And the greatest yield of your gold to silver swap, if you want to do that and achieve the highest effective yield, that is the cheapest way per ounce to buy silver made by the U.S. Mint with mint lineage.
And it's important to mention, for my whole career, you had to get back Social Security number when people sold over 1,000 face. and we had to file a 1099 on the behalf of the client. That law has been changed. So now people can sell back as much silver as they junk silver, the pre-65 to us. And although it still is reportable on their end, we're not filing a 1099 on behalf. So I don't know. I think on many levels, it's probably, man, especially playing the gold to silver swap, it's probably the best choice.
Folks, if you want to cash in some gold and swap it for silver at this extreme ratio, this gold to silver opportunity, do give us a call at 888-81-LIBERTY. And folks, if you don't want to miss a single episode with Andy or any of our other guests, make sure that you're on our free mailing list at libertyandfinance.com, all spelled out, all one word, libertyandfinance.com. Put your email address, click submit, make sure you confirm on the confirming email. We keep your privacy. We don't share your email address with anyone ever, promise. And we send you one email per day. We won't spam you in your inbox with our latest interviews, including every interview with Andy and all the weekly specials. You won't miss anything. So Andy, thanks for taking out this time today on your way back. Just had you fresh back to the country, and welcome home.
No, thank you, buddy. I appreciate it. It's good to see you. And hopefully on a live stream next week, we'll pick back up. But as always, I enjoy our good discussions. I hope you have a great rest of your day and look forward to picking up with you next week.
Take care. And thank you, everyone, for being here. Make sure you share this with any family, friends, coworkers, neighbors who haven't heard the word, because they're not hearing it on the weekly, on the news. But this is the word that they need to hear about why they should be diversifying into strategic tangible asset reserves instead of just staying vulnerable to a failing and vulnerable system that's highly leveraged. And Andy, thanks for keeping us ahead of the curve on that.
Always a pleasure, buddy. Talk to you soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for April 14th through April 21st, 2025, while supplies last. First this week, we feature 1-ounce silver Canadian maples at their lowest premium in years at just $3.49 over spot. Next, 1-ounce Gold Philharmonics are only $65 over spot. 1 10th-ounce Platinum Britannia are just $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.